Welcome to The Whole Steward, the holistic approach to wealth from a Christian worldview. I'm your host, Andrew Stanton, and I'm glad you've joined. Purchasing a home or investment property for the first time may seem scary, confusing, or impossible. Even when it's not your first, it's still a big and complicated task. Knowing the basics of how to qualify financially will go a long way in helping you go from browsing Redfin to getting the keys. We go over the basics of qualifying to buy a house today on The Whole Steward. This is episode number 63, and I'm so thankful you're listening. In fact, it will be the last episode, most likely, from this studio as you see it. We are moving to our new house, and having just gone through this process, yet again, it is a big task. You will be amazed, if you haven't done it before, how much you have to divulge of your own personal information to qualify to buy a house financially. But what I want to do is point out that borrowing money from the bank is not the only way to buy a house. There are a couple of other ways that we'll discuss today. And hopefully this is just a very basic overview for those of you who may be first-time home buyers, or maybe you've done it before, but you don't remember everything and you're about to do it again, or you're thinking about it. I had somebody ask me recently about what it takes to buy a house, and I realized that I had never gone through the basics here. And since we talk about real estate, it's one of my favorite asset classes. That's not to diminish other asset classes, but as an investment, it's very good. And as a place to live, it's also can be very good. I know I've talked about the advantages of buying versus renting. One of those advantages to renting is that you don't have to worry about any of what we're about to talk about today. Qualifying to rent a house is sort of similar, but quite different and much easier. You mostly just need a good credit score and proof of income, and somebody will rent you their house. But if you want to buy a house, totally different ballgame. Basically, if you're buying a house, you are now becoming responsible for that property. You are becoming the responsible steward of that property, and anybody who might joint venture with you or loan you money to do it is going to want to know that you're qualified to be that steward of that property, basically. So what I'm going to do today is just go over the basics of qualifying to buy a house. If you already know this stuff, it might be review, or you might just skip this episode, but these are the basics. Okay, so let's jump right in. What I want to talk about is three main ways that you can qualify financially to buy a house. Those three ways are: you can buy the house for cash. Straight up, you can pay cash for the house. Number two, you can borrow money from a bank with a conventional loan or a very traditional loan. This is probably the most common way, especially for first-time home buyers, to qualify to buy a house. And then the third way is creative financing. Now, we will go into the details of all three of these ways today. And it's going to be brief today because I have a lot to do. We are getting ready to move. Again, the studio's got to come down, and so this is our last episode. So, first, let's talk about buying a house with cash. This is probably the simplest way to buy a house. If you have the cash on hand in the bank, or, even if you have it under your mattress, I can't imagine that you would have that much under your mattress, and I hope you don't. But if you did, let's just say you have the money in the bank. We're going to use an example today of a $500,000 home purchase. Now, the investment properties that we talk about in the Midwest and the South, they are far below this, but the median is not too far below this number with inflation. Remember, inflation floats all the boats, and so Houses and properties are no exception. Those prices have inflated a lot, and the median home price has come up to what might seem like a really high level, but then you always have to compare it to the ratio of prices to income. And that has actually gone up. So prices are slightly more expensive than incomes, but we will dive into that in a little bit. If you have cash on hand, the point is that let's say you have a $500K purchase and you have $500,000 in the bank, you're going to need just a little bit more than that for closing costs. You will have far fewer closing costs if you buy with cash. And so part of what makes it so simple is that you just pay the escrow fees, the transfer taxes, and some other small miscellaneous things like if you do inspections or things like that. Those are all closing costs. And what we call opening escrow and closing escrow is just the period once you enter into contract to buy a house. You write an offer, the seller accepts the offer, and you open escrow. The escrow company is just a company that helps manage the financial aspects of the transaction, make sure all the documents are in place. They're going to record ownership with the county. They're going to transfer the ownership on the deed. They are going to make sure that the money comes from your bank account into the escrow account, and then they distribute the funds to all the people who need it from on the selling side. So when you open and close escrow, that's what I'm talking about there. So you have their fees, right? They charge a fee to do all of that, and then some other miscellaneous fees, as I mentioned. So you're going to need a little bit more than $500K, but not that much. So maybe an extra $5,000 or so, $10,000 to purchase a house. So you might need $505K or $510K, and nobody's going to check, right? You might, when you're writing the offer, you might show proof of funds, and that's a very common thing to do. You might just show, a partial statement, bank statement to the seller to say, hey, look, here's a piece of paper that says I have the ability to purchase your house, and that's the only qualifying you have to do. If the seller accepts the offer without seeing any of that, then you didn't even have to show that. They could accept the offer and not even need to see that. But a strong offer usually will be accompanied by some sort of proof of funds. Like, look, I'm writing the offer, I'm saying I'm going to pay cash, and here's the proof that I can do that. And that makes your offer much stronger. That's about the limit of what you need to do. I may be missing a few things, but that's the high-level view of purchasing for cash. Now, the most difficult part about that is not the transaction part. Buying a house for cash simplifies the transaction tremendously. The qualification process is quite easy. There's not really any. It's just what I described. The hard part is having the cash on hand to make that purchase. And very few people, although over the last 3-4 years, we have seen a lot of cash purchases. People who have the money, they have the wealth, and maybe they're selling a house in California and moving to the Midwest, and they're like, well, I could buy 3 of these things for cash or 5 of these things for cash. One house in Southern California buys 5 houses in the Midwest. That's just how it works. And so a lot of people have been doing that. That makes it very difficult for the people who grew up in those areas, who are, native to those areas. And they're like, well, all these people are coming in and buying houses for cash. It's very hard to compete with that because the transaction is so simple. Sellers love it. If you get a cash offer, it's like, wow, this thing is going to be easy to get through escrow, right? If you're on the other side of that, if you're the buyer, it's really hard to have the cash on hand, or it may be, it may not be, but there's a lot of reasons, even if you have the cash on hand, to not actually buy the house for cash. So that brings us to the second way, and this is the most common way that people would qualify, that you might qualify to buy a house or a property. Now, that is borrowing money in the conventional way from a bank. It's a very huge industry. The mortgage industry is massive. there are so many derivatives based on mortgages. It's a very stable, well, except in 2006, 7, 8 time frame. Mostly the system is very stable, and there's been a lot of things put in place to stabilize that even after the GFC, the great financial crisis. So this is a very big industry. It's a very common thing, and it's kind of expected that this would be the route that you would take, especially if you're a first-time home buyer. Now, what is conventional financing? Well, the banks look at the asset, the house, and they look at you as the borrower, and they want to qualify both. They're going to say, does the house qualify to loan money on it? And does the borrower, qualify to loan money on it? And what they will do is they will take the equity, they will hold the asset as collateral for the loan. Just like if you were getting a car loan, if you didn't pay your car loan, they'd repo your car. If you don't pay your house loan, they repo your house, right? That repo is repossess, right? They come, they knock on the door, and they say, this is ours now. It's great for the lenders because you have to put down a down payment. Usually you need to bring some cash to the table, and they will bring the rest of the cash to the table. And if you don't pay your mortgage, you're going to lose the house and your down payment. So the more money you put down out of your pocket, the more risk you're taking on, the more responsibility, the bigger the equity position you're taking on, and the smaller the bank is taking on. Banks love to see you put more money down. Why? Because you're taking more risk. You're having more skin in the game as the buyer, as the borrower. And so it's less risk for them. And if you don't pay your mortgage and they repossess the house, you also lose your down payment. So let's say you put 20% down, you can't make your payments for whatever reason, which I would never recommend doing. But if you couldn't, the bank is going to say, guess what? Your $100,000 down payment on this $500,000 house, you lost that. And the house is ours again. So they got $100,000 and a house from you. And so, they're going to hedge their risk in that way. And it's they're loaning you a lot of money to buy the house. And it makes sense to a certain extent. And there is very, very little leeway in this. I'm not saying there isn't any. You can negotiate with a bank if you're having trouble making your mortgage payment, things like that. But the point is that they are protecting themselves tremendously. But guess what? You get to control the whole house. If you make your mortgage payments on time, the bank won't bother you. They won't bat an eye. Well, there are certain regulations and things that they expect to be in place, but rarely do they ever check up on those things. In other words, like if you wanted to modify your house and completely make it, not up to code or whatever, they might check during escrow, but they're never going to ever check again. For example, I'll give you a perfect example of this. The lender required that there be a strap around the water heater. That's code around here. We have earthquakes, and the water heater needs a strap around it. Well, during escrow, it was discovered during the appraisal process that the water heater didn't have a strap, and the lender said it's got to have a strap. So we got to do another appraisal. You got to fix that and do another appraisal, and we just got to look that the strap is there, and then they would loan the money. It's small little silly things like that. It's very interesting. So getting back to how do you qualify then to borrow money from a bank? So there's a few ways that a few things that you need to look at. And what I recommend doing is doing your own underwriting. It's actually not that hard to do. And I will tell you right now, at least for me, I am more conservative than the banks. You might think, oh, it's hard to get a loan from the bank. Actually, what I find is that if you understand how this works, the bank is willing to loan you more money then you probably are comfortable borrowing yourself. And we'll dive into why that is right now. But some of the pros of borrowing money from a bank is that Fannie Mae, Freddie Mac loans are sponsored by the government. They're insured by the government. They're backed up by the government. And that's why you get these really low, even though you might think they're higher now. They're around national averages for a long time, decades now. If you look at 7% as close to the national average, that's not bad. And so it's a 30-year fixed rate mortgage. That means the interest rate is fixed for 30 years and it's amortized over 30 years. All that means is that you're going to pay interest every year and some principal every year. And it's worked out so that if you do that for 30 years, you will then owe $0 to the bank and the loan will be paid off. And that's what the amortization schedule shows you. Borrowing money from the bank can be very advantageous. As I said, you don't have to have all the cash on hand. You only have to have the down payment. And even saving up a down payment might be difficult depending on your situation, but you can do it. It's a lot less if you're getting a loan. Some of the cons are that you are beholden to the lender. You have to make that mortgage payment. I've been told, and I've never come to this, but if it's a choice between eating or paying your mortgage payment, you pay your mortgage payment. Right now, I know there might be some debate on that, and the whole concept of pay yourself first and things like that. You probably want to get creative rather than making the bank mad at you. You probably want to get creative to solve a financial problem if you can't actually make a mortgage payment. And that's all that means when you say a choice between eating or paying your mortgage payment, you pay your mortgage rather than eating. It's, what it says is you got to get creative and try not to make your lenders mad at you, or give them any reason to be mad at you. So, the other disadvantage of borrowing money from the bank is, unlike the scenario where I described you can buy a house for cash, the bank is going to vet you and your personal financial situation tremendously to the nth degree. And you might feel like it's an invasion of privacy. You might feel like, boy, they want to know everything about me. They know more about me than I know about myself, I often say. And it doesn't have to be that way. Yes, they are going to do all that checking. But the point of today is to help you do that checking, that underwriting, that qualification, that self-qualification process prior to them having to do it, so that you can go to the bank and they're going to lend me money in this way because I qualify. And in fact, they will qualify you for more than probably you're going to be comfortable with yourself. And so this is meant to help you with that process, understanding that process. So with that being said, those are some of the pros and cons of borrowing money from the bank. There's more. You can let me know in the comments anything that I have missed or didn't mention. But the bank is going to look at three main things to qualify you. They're going to look at your credit score, they're going to look at your income, and they're going to look at your assets. Those three things are the main thing, among a few other minor things. But financially, those are the three things they're going to look at. Now, your credit score is important because, and we could talk about, the sham nature of credit scores all day long. This is not meant for that. I'm telling you from the bank's perspective why it's important. Here's what they're going to do. The credit score, your credit score, shows a history of your payments on your debts. It shows the balance ratios that you have on your credit cards, for example. It shows what your starting balances were and how much you've paid up until this point on the various debts that you have. It shows your on-time payments, whether they're late or on time. It shows how many inquiries you've had on your credit score. And a lot of people try to avoid that piece. Though, the bank will ask you, hey, is it okay to run your credit? Because the more times you run your credit, that counts against your credit score a little bit, because it might look like you're having trouble getting a loan and you're trying a whole bunch of different times at different places to get a loan. But it's actually a small piece of your credit score. How many inquiries is, I think it was only about 5% of your credit score. And so if you do this a lot or all the time and you have good history, and in all the other areas I just described, your inquiries portion of your credit score really has very little impact. So I wouldn't worry about that piece too much if you're strong in your payment history, your balance ratios, and your on-time payments, all those things. If you have a 740 or better credit score, from a mortgage lending standpoint, when purchasing a property, it's really not going to change anything. You might say, Andrew, I got a great score. I got 810. I have an 810 score. Okay, great. I've got an 845, and it doesn't matter. We're going to get the same loan, the same terms. 740 or better. That's the best you can be. But you can buy a house with far below a 740. You're just going to get a little bit less favorable terms. And as you go down in credit score, the harder, the worse the terms are, the harder it is to borrow the money. The higher the interest rate, the higher the fees, things like that. They are going to want more from you if you have a lower credit score. And you might think, well, that's not fair. The guy who has a lower credit score is not as well positioned to pay a higher price. Yeah, exactly. It deters. It's like a filter. If the bank looks at you as a higher risk because you have a lower credit score, they're going to want more from you to hedge themselves against that risk. If you have a better score, they're going to look at you as a lower risk, and they're going to give you a better deal, a better rate, all those things. So that's the credit score piece. You can know what your credit score is. You can get 3 credit reports per year, 1 per year from each credit bureau. So what a lot of people like to do, and a little tip, is you can run from, I think it's annualcreditreport.com. You can get 1 credit report 3 times a year, spreading them out from each of the agencies, and you can see where your credit score is. You can look at what you have on your credit score. It's the same thing the banks are going to be looking at. So I highly recommend doing that, and you can do it ahead of time. You can run your own credit, right? And you have a right to know what's on that credit score. The second piece the bank's going to look at is income. They are going to want to know how much money you make. And it's not just how much money your business brings in or something like that. It's your actual earned income. That's what they're looking at. So as a W-2 employee, if you have W-2 income, it's very easy for them to qualify you, because they look at it and they say, okay, you know what, you have this amount of earned income, and you qualify for this amount of income. And we want to make sure that you have the income, enough income to pay your debts. So they're going to want 2 years of tax returns. And the reason for that is because they want to see the earned income. If you run a business and you bring a lot of money in, but you write your car off, you write your house off, you write your office, you write all your supplies, you write your food off, you write all this stuff off, those look like business expenses. That's not earned income. The bank is going to look at that and say, well, those were all business expenses. That's not earned income. And so you might, as a business owner, and I have friends who have had to do this, you might have to claim more of those things and not write them off to show earned income to the bank to qualify for the loan. So it's earned income. You're going to need to provide probably 2 months worth of pay stubs if you are a W-2, and you're going to need to provide your W-2s, probably 2 years of W-2 forms, and those show your income, right? What you told the government that you made in income. So all of these things will play into your DTI. That's your debt to income ratio. Your your debts are whatever shows up on your credit score, and your income is whatever shows up on your tax returns, your W-2, right? So that ratio, your debts to income, is your DTI. So if you have $10,000 in income and your debts are $5,000 a month, and this is all monthly, then your DTI is 50%. Your debts are 50% of your income. And again, it's gross income. So it's all before taxes and all that stuff. It's just what is your gross earned income. Now, if you make $10,000, let's just say you have some other debts on your credit score that show up on your credit report. You have a car payment. Let's say it's $560 a month. Car payment, and you have credit cards. With the credit cards, you might pay them off in full, and I highly recommend doing that. You get all the benefits of using a credit card. You get the insurance, you get the fraud protection, you get the percentage points back, the rewards, and all that stuff. Credit cards are great, much more secure than debit cards, for example. But you might have a balance every month, and I would highly recommend, if you use credit cards like I do, that you pay them off every month. And that's a common thing to do if you're using them as a financial tool in that way. Now, the bank is going to look at, or the credit report looks at the minimum monthly payment. So let's say you run up your credit card to $2,000 a month in groceries, expenses, gas, all that stuff, living expenses. You're going to most likely pay that off if you're paying your credit card off every month. So you would pay $2,000. But it's not going to count the whole balance towards your DTI. It's only the minimum monthly payment. If you were to not make another purchase on your credit card and you were to pay the minimum payments and pay it down, the bank will say, okay, here's your minimum monthly payment. So let's say in this example that your minimum monthly payment is $120 on your credit card. So you have a car payment, $560. You have a credit card minimum payment of $120. So your total debt right now is $680 a month. So your DTI then at $10,000 per month is pretty low. It's it's below. Well, we could do the calculation. This should be an easy calculation because it's $10,000. So your debt is $680 a month. Your income is $10,000, and so you're at a 6.8% DTI. Now, that is not with a mortgage payment. By the way, the bank will look at your rent as well. Usually, when you're trying to qualify for a loan and you have a rent that you're paying, they will also count that into your DTI. Even though it's not technically a debt that, like a loan that you're paying on, they will still count that. But if you're going from renting to purchasing and you're going to live in the house as a primary residence, they will ignore the rent that you're paying and they will just look at your new DTI once you buy the house. So that's why I ignore the rental piece. But if you're buying a investment property, they are going to look at that and count that in. But they can also count the rental income, up to 75% of the rental income of the new house that you're purchasing, if you work with a lender who is accustomed to rental properties and loaning on that. Like Aaron Chapman, who I interviewed back in one of the early episodes. So you can talk to Aaron if you need to get a loan for an investment property, especially in the South or Midwest. So back to DTI and your income. This is why they look at your income. They want to make sure that your monthly debts do not exceed some threshold. Now, for a conventional loan, you can put up to 5% down, all the way up to 20, 30% down, whatever. The DTI, typically for that, if you're working with a good lender, and not all lenders are created the same. Think of a lender as a broker. He's a guy, most likely, unless you're going directly to an individual bank, usually you'll work with a broker who will shop a lot of banks, and he will usually have a threshold, and it's not all the same. Like my credit union has a much lower DTI threshold than my broker. There's a lot of banks who will go higher than that, but not all banks have the same threshold. I remember one of them was a 30% DTI. Another, the one that I work with now, will go up to a 50% DTI. And then on an FHA loan, you can go all the way up to 56% DTI. Now think about this for a second. If your debts are 56% of your monthly income, that's going to be a very tight financial situation. For example, and keep in mind, they are looking at gross income. So if your gross income is $10K a month and your DTI is actually 56%, that means $5,600 every month is going to just servicing your debts. That's your mortgage, your car payment, your credit card minimum payments, all those things that show up on your credit report. That's going to be a very tight financial situation. You're going to have a very interesting and difficult time, because you also have to pay for your food, your living expenses, your taxes, your everything else has to come out of your gross income. And you're going to find that that's a very tight financial situation. This is why I say earlier that the bank will loan you probably more than you're going to be comfortable with yourself. So you can figure out your own DTI. You can run your credit. You can run your own credit, or you can just know what your debts are. You know what shows up on your credit report. If you're familiar with it, you should be familiar with your credit report. And then number two, your income. And the ratio of those two is your DTI. I told you that the bank will likely go up. If you're working with a good flexible lender, they'll go up to 50% DTI on a conventional loan. So keep that in mind. You can qualify yourself prior to even talking to a bank or a lender or broker if you want to. And so I just taught you how to do it. This DTI I'm talking about is the back end DTI. Your front end DTI is just what goes towards your mortgage payment. And then the back end DTI is the overall ratio that we just looked at. And keep in mind, when you're talking about your mortgage payment, it's going to be principal, interest, taxes, insurance, private mortgage insurance, if you have that, and we'll talk about what that means in a minute, and then HOA fees or things like that. So all of those count towards your DTI, and just have that magic number of 50%. That's more than you probably want to do. I think average would be somewhere around 30%. You want to, you don't want to stretch yourself too far, because it's going to be very uncomfortable. Not impossible, unless you have a lot of expenses besides your debts. So just keep that in mind. You can kind of see, okay, how are the finances going to work? And if you do a financial statement like we talk about on the whole Steward, you're going to have this worked out really quickly and easily. If you do this a few times, you can start to even do it in your head, and you can calculate your DTI really quick based on what you have as debts. Keep in mind that your taxes are usually around 1 to 1.2% of the purchase price, which is the assessed value. And these are property taxes we're talking about now. So 1% of the purchase price per year. And then your insurance costs might be about 0.5% of the purchase price per year. So you can look at your principal, which is the amount going towards paying down your loan, the interest, which is the fee that you pay the bank for using their money, just like you would rent a car or a boat or whatever else you want to rent, a rototiller at Home Depot. You're going to rent money, And so you're going to pay the rental fee for the money. You're going to pay some of the principal down. You're going to pay your property taxes. You're going to pay your insurance company. And by the way, the lender is going to require that you have insurance on your property, because if it burns down, and you don't have the money to replace it, they don't want to be out the house either. Now their collateral is gone, and you're not going to pay you likely wouldn't pay a mortgage for a piece of dirt on a burned down house. So anyways, they're going to want you to have insurance. And so that's principal, insurance, principal, interest, taxes, insurance, and then of course your HOA. You got to love the HOAs. Don't they do great things for us? The HOA is an association that maintains, the common areas of the neighborhood, and among other things. And a lot of people don't like them. Some people like them. There's a lot of politics around it. Anyways, that contributes as well. So that's how you calculate your DTI. Now, let's move to the third thing that the banks are going to look at. The third thing they're going to look at is your assets. Now, what does that mean, your assets? Well, they're going to want to know what cash do you have, or what assets do you have that would qualify you to purchase this house. They're going to want to see that you are responsible. You are the steward of the money that you are purchasing the house with. If it's not your money, they're not going to like that. Unless you get a gift letter, which then makes the money your money. So for example, you want to buy a house for $500,000, okay? $500K. You could if you put 20% down on the house, that's $100K. So you need to have $100K down payment plus all the closing costs. And now, since we're talking about using a lender, a bank, borrowing money from a bank, you're going to have a lot of additional closing costs, because you're going to have an appraisal. You're going to have to pay the lender his fee. You're going to have to pay the underwriting. You're going to have to pay the underwriting is the bank. You're going to have to pay their fee. You're going to have to pay more in closing costs. And so that is going to be more than $100K that you need to bring to the table. And they're going to want to know that you have that money and that it belongs to you. There's different ways to come up with that money. You could get, some people will save their cash, save their money every month until they have a down payment saved up, right? Or you could get a gift letter, which is a letter that states, let's say your mom and dad want to help you buy a house for the first time. They will write a letter that says, I'm giving Andrew $50,000 for purchasing this house, and I expect no repayment for it. Now, a lot of times when parents do this for children, the children will pay their parents back, but the bank has to see that it's not required, and they don't want to know that you're going to do that. They want to know that the whole down payment came as a big chunk that belonged to you. And so in order for it to be considered to be belonging to you, it has to be gifted to you, or it has to be proved that it's yours by showing your bank history. For example, the funds have to be seasoned. So if you have money sitting in the bank, the seasoning period is usually about 30 days. For most banks, it may be longer or shorter, depending, but they're going to want to see that that money has been sitting in your bank account for a certain amount of time. And in that case, then they will consider it yours, and you have the authority to, use it as a down payment. If you had a big transfer of funds into your bank account in the last, 10 days, they're going to want to see, where did those funds come from? They're going to want to know if it's from your mom and dad because they're helping you buy a house. They're going to want to see a letter that says this is from mom and dad. They don't expect to be paid back, blah, blah, blah. But let's say this isn't your first time home purchase. You're selling another house, and there's a big deposit from an escrow company because you sold your other house. They're going to want to see the closing statement that says Andrew just closed escrow on this other house, and those funds came, the house belonged to him, and then the funds came into the account here. They're going to want to trace all of this. And so, you have to be prepared for the funds to be seasoned or traceable. And sometimes it can be a real pain, and they're not going to want to see any big transfers or movements of money. They're going to look for just, standard, monthly expenses transactions, and any big deposits that are unexplained, that are not from your claimed income, are going to be questioned, and you're going to have to explain them or not count them. You can also not count them towards the money, but that you're using for the down payment. But that could be a problem, because if you need all the funds in the account, then it'll be a big deal. I'll give you an example. I was using a loan from my life insurance, cash value life insurance accounts to buy the house. But in the meantime, we closed escrow on another house, so we had a deposit. So rather than having to trace the funds that came from the life insurance account, I just showed the closing disclosure, or the closing statement for the house that closed, and the bank said, okay, we just won't count these other ones. And it's as if you didn't have that money, when in reality it was there, but they just have to trace it all. And they're protecting themselves and in this whole process. So let's get back to the the big takeaway is you have to have proof of funds, proof of assets. So we're on the third thing the bank's looking at. And they have to be traceable, and they have to belong to you. You have to have the authority to have those funds and use them. So, however you accomplish that, whether it's through documentation that shows the funds are traceable, whether it's from a gift letter that says mom and dad don't expect to be paid back and this is where the money came from, or whether it's just your own funds that have been sitting there for a long time and they're seasoned, what we call seasoned, however you accomplish it, the bank is going to look at it and verify it and vet you to the nth degree. They're going to cross all their T's, dot all their I's. So you might as well do that ahead of time. Don't wait for the bank to force you to do it. You can do that ahead of time. You can pre-qualify yourself, basically, by looking at, okay, where's the down payment going to come from? Where are the closing costs going to come from? Are they seasoned? Are they traceable? Are they all these things? You can answer those things. So if you look at an example, our 500K example, you could also put less money down. With conventional financing, you can put as low as 5% down. But if you're putting less than 20% down, the bank says, hold on a minute. Now you're a higher risk. You are not having as much skin in the game, and we're having to loan you even more money to buy this house. And so you need to carry private mortgage insurance. That is, that if you don't pay your mortgage for whatever reason, the private mortgage insurance protects the bank. If the deal goes south, if the loan goes bad, then they are protected with private mortgage insurance. And guess what? You, as the borrower, have to pay for that. You have to pay for that insurance. And guess what else? That insurance payment counts toward your DTI. That's part of your monthly payment. Now, if you get a conventional loan, you can, after you build up enough equity, let's say you have 20% equity in the house now, you can get that PMI removed, that private mortgage insurance. They will just drop it, and now your mortgage payment actually goes down at that point once you drop the mortgage insurance. However, if you're getting FHA and you're putting down as little as 5% or even 3.5%, you can put as little as 3.5% down on a home purchase, that PMI is permanent until you refinance. What does it mean to refinance? Well, that just means after you've had the loan for X number of time, maybe a couple years, you could go to a bank and say, hey, look, I have this house and I want to borrow money. Almost the same process to qualify as when you're purchasing. But the bank will say, okay, yeah, sure, you can pay off your old loan and you can get a new loan. And that new loan could have totally different terms than your original purchase. So you, as they say, you marry the house, but you date the interest rate. So make sure the house you're buying is the one you want. You can't change that. And well, you can, but you can't change its location. That's why they say location, location, location. You can improve the house and all that stuff. But once you have the house, that's kind of fixed. But the funding, the loan, that is negotiable. Real estate's amazing. When you negotiate a deal, real estate's one of the few asset classes that you can renegotiate the deal. The financial aspects of the deal can be renegotiated because the loan could be renegotiated. You could either renegotiate the loan that you have, which is very rare. Banks just pretty much it's 30-year fixed and it just doesn't change. Or you can refinance and get maybe a better rate, or maybe better terms, or maybe a conventional this time if you went FHA the first time. So there's flexibility there, but keep in mind that if you don't refinance and you put less than 5% down, or even for FHA, I think if you put 5% down, the PMI, I think this might be it, that is fixed. It's stuck there. You can't even drop it. So that would be one advantage of going conventional. However, what I've found recently is that conventional interest rates are much higher right now than FHA. So it just depends. Ask your lender. They can help you with that part. But the point is that if you put 20% down, you're going to have to come up with $100K in assets. More than that. They're going to want to see that you have the closing costs as well. 5% would be a $25K down payment. And 3.5% would be a $17.5K down payment. So you're going to have this cash on hand. So you need to have let's recap then. You're going to have the credit score. You're going to have the income. And you're going to have the assets. I just taught you how to, I just showed you how to do your own underwriting, to look at your own financial situation, kind of see what do I qualify for. And you can use a mortgage calculator. I have one on my phone called Carl's Mortgage Calculator. It's free. And I use that thing all the time. I'm always just punching the numbers in, and I know what my DTI is. I know then what I can afford. And the bank is going to qualify you based on your monthly payment. The purchase price actually doesn't really matter. If the purchase price is low, but the interest rate is high, you're going to qualify for whatever it is. If the purchase price is really high, but the interest rate is low, you're going to qualify for that purchase price. And if they're both high, then you're going to qualify for much less. Right now, what I think might happen is when the economy really starts to go south and interest rates, the way they address that is they lower interest rates. What you're going to see is that everybody who's qualifying for houses right now at this certain level, they're going to then now qualify at a higher purchase price, and you're going to see prices drive up. That's assuming that the people who are buying those houses still have the income to support it. A lot of times, if the economy is crashing, it's because people are losing their jobs, and then they don't have the second piece that the bank looks at, which is the income. They're going to say, well, what's your income? Well, I don't even have a job. Well, we're not going to loan you money, so they can't buy a house. And that's a negative cycle that you could see, prices dip on. But for the most part, you will be qualified based on that monthly payment, and that's what you can afford. Basically, you can figure out how much of a purchase price you can afford based on these things. So that's really kind of the overview. To carry the example that we've been looking at, the $500K purchase price, if you got, let's say, a 7% interest rate, your principal and interest only, your P&I, would be $3,210.08 per month. Now, your taxes, which are, let's say around 1 to 1.2%, would be about $6,000 a month. I'm sorry, not per month, per year. So divide that by 12. And then your insurance might be about, if it's about 0.5% of the purchase price, that's about $2,500 a year. And then let's say that you put 5% down on that conventional loan. So you had PMI, your private mortgage insurance, another $200 a month. So your mortgage payment is about $4,118.42. Okay, it's about that easy. Now your PMI will vary depending on a lot of different factors. Talk to your lender about that. But this is just a rough estimate. And most of the online house browsing apps like Redfin or Zillow or whatever, they can account for this. When it shows you what your monthly payment is going to be, they're accounting for these things. And so now you know what all these things mean. If you look at a 50% DTI, let's say your income is $10,000 a month, your DTI would be at 50% would be $5,000 a month, could be debt payments. And if you have that car payment that we talked about and the credit card payments that we talked about, those are allowing you then to have a $4,320 mortgage payment. So this $500,000 purchase price with a $4,100 payment is really close to that 50% DTI ratio, assuming you had the car payment and the credit card payment in this example. So you might say, well, okay, I make $10,000 a month in income and I have enough money for a 5% down payment plus closing costs. So I can afford about a $4,100 a month payment, and that means a $500,000 house. Now, like I said before, you need to figure out what you're comfortable with. The bank, what I've learned is that they will loan you more than you're probably going to be comfortable with. I think the first house I bought when we were first married was a 43% DTI. And that was a stretch. That was really hard to get by. You know, you're paying your taxes, you're paying for your groceries, you're paying for your gas, you're paying for, your cars, whatever you're paying for, plus this big huge mortgage payment now. So just keep in mind, don't overstretch yourself. Make sure that if you've done your financial statement, here's your income, here's your expenses, and you can make this work, then more power to you. The bank will loan you probably more than you're comfortable with. That's the takeaway. Now, that brings me, and we'll wrap up with this, the final method of buying a house that I wanted to talk about today, and that is creative finance. Well, what is creative finance? That is not going to a bank. Okay, it doesn't necessarily mean buying for cash, but it could be much closer to that. It's simpler. Creative finance might be you get seller financing. So here's a guy who owns his house. He's owned it for 40 years. He doesn't need the money, but he wants to sell the house. You can give him a down payment, and he'll just carry the rest of the balance as a loan. And you get to negotiate that directly with him. No banks involved. No credit bureaus involved. No traceability or, all that stuff. It's whatever the seller wants to see. And usually it's a lot less than the bank. It's also very flexible on the terms. A lot of sellers will say, I have a friend who just bought a house with seller financing. He wouldn't have qualified for the house from the bank. The bank would have said, nope, can't do it for all the reasons we just discussed. But the seller said, sure, we can do it. We'll do this interest rate for this term. It'll be amortized over 30 years with a balloon payment at 10 years, for example. And so now you're going to pay a mortgage payment as if you were paying it off in 30 years, but at year 10, you're going to owe the balance. Whatever's remaining, you got to pay that off. And so you'll have to refinance. You'll have to get a new loan, or at that point, you'll have to sell the house. And somehow you're going to have to pay that loan off. But that's an example of creative financing. Another way to do creative financing is to borrow money privately. So you could do a joint venture with your brother, for example. If you have a good relationship with your brother and you want to do all the legwork of buying the house and he wants to bring the money, now you just made a partnership and bought a house, but you didn't actually have the money yourself, so it was creative financing. So you see how that works. There's so many ways. The creative financing is endless. It's absolutely endless. You can do what's called syndication to buy a property. You can bring a whole bunch of different people together, and they all pitch in $20. You bring 5 people together that pitch in $20K, and now you've got the $100K to buy the investment property, and you all split the proceeds. You just put together a little mini syndication, and now you can, you could be the manager of that investment. A lot of times people who are doing that will want to see you have skin in the game as well. But the reason why it's creative financing is because you guys get to figure it out. Whatever the terms are, I would recommend, drawing up documentation that is official. So don't skip on documentation just because you don't have a bank forcing you to do it. But still, it's creative financing and you can buy a house that way. If your mom and dad want to gift you all the money to buy your house, right? That's another way. It wasn't your money, but you still got to buy the house because you did creative financing. That's not that creative, but anyways, you get the idea. So that's the third way. Number 1, for cash. Number 2, traditional, conventional financing from the bank. Number 3, creative financing. You could buy a house, and you could buy it today. Remember, always ask the question, how can I? Don't ever say, I can't. If you say, I can't buy a house, well, you definitely can't, because you just shut your brain down, stopped working on it. If you say, I can't do it, your brain kind of stops working on it, goes on to something else. But if you say, how can I? It's an open-ended question. It leaves your brain working on it. How could I make this work? What if I put more money down? What if I claim more income on my tax return? What if I get a gift letter from my mom and dad? What if the questions are endless. If you say, how can I? That leaves the door open. You also want to just make sure that you don't overextend yourself in whatever you're doing. One note on buying an investment property, you will likely have to put 20% down. Some of the lenders are doing as low as 15% down, and there's some lenders that will even work with you beyond that. But generally speaking, 20% down is pretty typical when you're buying a rental property. If you're buying a primary residence, the banks will allow you to put far less money down. Of course, you'll carry that PMI, but they figure that if you're living in the house, you're much more likely to try to make it work if you're having trouble making your mortgage payments than if you have a rental property that's, somewhere else. You're much more likely to just let that thing go and not pay your mortgage. So since they see it as a higher risk, they require more money down. But again, that's not true for all investment property loans. Just you can ask your lender about that if you want to do it that way. So that's what I have for today. I hope you found it very helpful. And shout out to Niklas, and shout out to the listener question who and shout out to Niklas who asked the question about how do I afford a house? How do I buy a house? How do I finance a house? And this is how you can do it. You can self-qualify yourself before you even talk to the bank. You might have to, make a little adjustments here. They want to see some paper or whatever. Keep in mind, you're going to feel like it's a huge invasion of privacy. I've gotten used to it because I've done this so many times, but nonetheless, it's still not exactly a pleasant process. But those are your options. And once you get a house and you are the steward of that house or that property, you now have something tangible. Remember, it's not so much spending money. All the fees and things for the closing costs, yes, that's all, money out the door. But anything you put towards principal, whether it's your down payment or the principal payments of your mortgage, those things are going towards building equity in a real asset, something that you can walk up to, you can kick it, you can touch it, you can feel it, all of that stuff. So it's a real thing. So you're just converting financial capital to physical capital, to material capital, I should say. That's a whole Steward concept. And from a Christian worldview, you want to do this entire process honestly. You're not going to cheat. You're not going to swindle. You're not going to do any of those things. And just a note, I would say, from a Christian worldview, there is the concept of you shouldn't borrow money to do any of this. I touched on it a little bit earlier. I disagree with that because borrowing money is just renting money. That's all it is. Would those same people who say you shouldn't borrow money to do this say that you shouldn't rent a car or you shouldn't rent the rototiller from Home Depot to do your garden once a year? You shouldn't rent anything. You should buy everything for cash straight up. That's, would they say you shouldn't rent your home? Renting is a very viable option. And so borrowing money is just renting money. And the interest rate is just the rental fee. That's all it is. You're going to rent money to do something with it, and you're going to give it back with the fee. And so if, and the Bible says, owe no man anything but to love one another. Well, if you are in debt, you need to make sure that you don't get over leveraged with how much money you borrow to do these things. And over leverage is probably a subjective thing, but you don't want to have more debt than assets, for example. That's a bad thing. You're underwater. You have a negative net worth at that point. But the point is that if you have a loan, once you make your mortgage payment for that month, you don't owe any man anything. You already determined the terms of the rental fee, the interest for the loan. So once you make your mortgage payment, you don't owe any man anything until the next month when you owe him again, but then you pay him again and then you don't owe him anything. So the point is that borrowing money is just like paying a rental fee for using an asset. That's all it is. It's whether it's dollars or a car or a house or a boat or a rototiller, you're gonna rent it, you're gonna pay a fee for it, and you're gonna give it back in the same condition and a fee. So that's how I look at it. If you disagree, let me know. Let's have some good discussion on that. I'll certainly answer your questions on that. But I don't have any issue renting money to buy real estate, same as I don't have any issue renting real estate to live in, for example. So that's sort of the my perspective on the Christian worldview on this whole thing. And you got your 3 ways how you can buy real estate. Remember, ask the question, how can I? Don't say I can't, because your brain shuts off. Say, how can I? That's all I have. Think abundantly. And now that you know more, go out.
All content on The Whole Steward is for informational purposes only and must not be considered personal, professional, tax, or legal advice. Please consult an appropriate professional for individualized advice. Though we do our best to bring you reliable information, we make no guarantee on its accuracy, so you must rely on your own due diligence to draw your own conclusions. The views expressed by guests on the show are their own and may not represent that of the host. Please visit our website for complete terms and conditions.
Thanks for joining us today for the holistic approach to wealth from a Christian worldview. This show is brought to you by thewholesteward.com.